Hey everyone, welcome to another edition #AskRobCo. Hope you're all well. Welcome James with us as always. It's been another busy week. I've been traveling around Europe. The Olympics have been producing some excellent results, as we were saying a week ago. And today has been another great day in the Olympics, and it's fascinating to watch how Team GB are doing in Tokyo. And let's hope they continue to produce excellent results, as they are broadly online with what they produced in both Rio and in the London Olympics 2012. I think at the end of the week, we've got the football season starting next week, I think. So we'll hear from James on that. In the property market, August notoriously is a relatively quiet month. I think what we're seeing at the moment is that especially overseas buyers, investors, interests in the market are probably returning to their homes for most of the summer, taking advantage of that opportunity of travelling again and possibly doing some home-based work as well. So we're seeing, I would say, a longer summer this year, and probably looking at a 6-week period of where things are quieter and slower, as we would have seen previous years. All good, James? How's things?
Yeah, no, really good, thanks, Rob. Really good. Like you say, there's been sort of a few macro events in both the economy and also with the schools breaking up a few weeks ago in July. July came on the back of the stamp duty incentives coming to a close, with a lot of those savings being now reduced to £2,500 up until the end of September this year. And that, coupled with July, August being typically seasonally quieter months in the property market, and our data currently is reflecting that, but it's also it's slightly more prevalent with the June figures being some of the best we've ever seen on record. And I think in a couple of months' time, we're going to see the Land Registry release some of their official data on that in terms of transactions for June. And there's ourselves and also Rightmove have released statements saying it could be one of the busiest months in terms of transaction volumes we've ever seen. So that would be an interesting one to see, and just how those small tweaks in terms of the government intervention in terms of the stamp duty savings, how much of an impact that can have on both the London market and nationally across the country, how many more sales there's been, and also just that sort of restarting the economy as we move out of the pandemic.
Great. And what are the latest numbers and data we've got this week for everyone?
So in the past week, we've had sales this week slightly down last week, 107 sales for this week, which we're sort of on a benchmark basis, we're over the 100 figure, but it's more aligned with those quieter months we've seen this year. Right at the very start of January, also we've said before that Easter months were fairly quiet, as people were obviously off for the long bank holiday there. So as we move through July and into August, we're seeing subdued levels of transaction volumes, slightly down on the new instructions. But as we say, it's not normally at the forefront of people's minds, their focus. It's not a typical time of year seasonally to launch new properties to the market and for buyers to be actively searching for their requirements in terms of properties to buy. So we're probably expecting a quieter couple of months, with maybe some more activity returning to the market come the start of September. Children will be back to school. There'll be sort of higher percentage volumes of people in the UK that will be double vaccinated as well. Let's see what happens and sort of really reassess the data come the sort of opening weeks of September.
Yeah, I think new instruction levels are hovering around the 300 figure, and that's where they've been for the last month. And what normally happens is second week in September, once the schools go back, then we see a dramatic increase in new instructions that kicks the market in for the last quarter of the year. So I'm with you on that one. We need to see how the next few weeks plays out.
That's it. And if we look at the instructions that we saw at the very height of the market we've seen in the last 12 months, those summer months after the pandemic of June, July, August 2020, instructions were in the region of 600 per week, with sales generally achieving in excess of 200 weekly sales. And we're roughly half, we're around 300 now, and we're roughly about 100 on the sales. So I think in terms of available stock, the proportion which is selling is broadly similar to those figures which we were seeing at the busier times of the market, some of that pent-up demand which we were seeing as we came out of the initial lockdowns.
I think one of the most interesting things that's happened in the last week has been the opening of the borders for European and North Americans who have been double vaccinated to travel, because in the prime, super prime market, that space is very much reliant on, I would say, all overseas travel from all overseas investors and buyers. And the one thing that hasn't been happening over the pandemic is that international investor level purchasing, even though the prime, super prime has seen relatively strong sales numbers and figures. Now we're going to see the reality, I would say, of how strong the overseas buyer market is going to be, and is there going to be any pent up demand that comes through from that?
Yeah, I mean, obviously, international travel has been hugely restricted in the last 18 months, and those overseas buyers that have had a requirement to acquire a property here in the UK, or more specifically, possibly in London, those prime areas, may now be taking the opportunity to visit London and possibly acquire property. It's going to mean that there's possibly slightly more purchases in the market in that prime space. However, the international buyers are now subject to the non-domestic stamp duty surcharge of additional 2% on top of the prevailing stamp duty rates, which it's a fairly new taxation here in the UK. It came in April early this year. So the market has yet to really fully adapt to that, and we're yet to see how it affects those international buyers and possibly even pricing in that market. So far, the super prime London, as we've been reporting, has been performing extremely well, and it's been made up of not only domestic buyers, there has been some European buyers and overseas international buyers still acquiring property in the UK, although that's largely come through buying agents and relocation agents which have been acting on their behalf.
Yeah, I think interesting for the audience, people listening, is that prime, super prime, even in the last month, has performed well and consistently with the previous months, which shows how robust it is. You know, your London and Greater London and some of your home counties. And now we get the opportunity over the next 4, 6, 8 weeks to see if there's going to be an influx from the overseas investor to a greater degree, and with the private banking, upper tier lending, whether retail as well, let's see if there's going to be increased activity, and we'll keep you up to date with the profile of buyer and the profile of activity that's happening in that space in the market, so that everyone is aware. So we'll watch that space. What else have you got for us, James?
Well, in terms of property news and also a bit of a positive in the housing market, Taylor Wimpys recorded some record build figures for the first half of 2021. The developers completed 7,303 homes in the last 6 months to date to the 4th of July, which, if we look back at this period, same period last year, only 2,771 homes were completed. However, that period was obviously affected partially by the pandemic, but a massive uplift in their delivery of new homes to that sector. Furthermore, in terms of the full year completions, these are expected for Taylor Wimpey to come in at the upper end of their forecast. Now they're forecasting about 13,000 to 14,000 new home completions. And if you look at the business as a whole, their operating profit is forecast to be around £820 million, which would exceed previous expectations. So some positivity there. There has been a slight cautionary note from them, just in terms of the slight reduction they're predicting in terms of the activity in the second half of the year, on the back of some of the peaks which we've had in quarter one and quarter two this year, which are largely on the back of the stamp duty threshold incentives there, and they're expecting the market to return to some sort of more normality, and those seasonal trends to become more prevalent in 2022. Furthermore, the residential developer London Square has delivered a very strong performance in its latest annual results, increasing its operating profits, its off-plan sales have gone up, and also its land pipeline has increased over 50%, with a gross development value in the region of £1.7 billion. And we know that London Square are the JV development partner with Peabody on the Holloway Prison site, which again is a master plan scheme in Islington. It'll be delivering 980 new build homes there, just off the Holloway Road. It's going to be around 60% affordable, obviously with Peabody being quite an active RP in London. So that'll be an interesting one to see, but some positivity there, Rob, in terms of some of the house builders on the half year, calendar year point. Some positivity. We're returning to the build rates which we've seen in sort of more normal calendar years of the 2019 onwards.
Yeah, I think the challenge and the watch this space, maybe not with the mass market volume builders, but what we're seeing with more bespoke individual schemes, and we've discussed this on numerous occasions, is the lack of supply of materials and product and the delays that are coming with that, and then the cost increase and overrun that's having an impact on those schemes can have a really detrimental effect on value and on GDVs. What are your thoughts on that, and where is this all going to end?
Well, definitely, Rob. We saw it last year. I mean, as the stamp duty threshold was coming to a close in previous points over the last 6 months, we did notice in certain markets second-hand homes which were available to transact upon, those resales in some of the new build developments, that people were maybe taking the opportunity to sell their home as the latest phases were delayed and the proposed completion dates weren't falling in line with to take advantage of the stamp duty threshold savings. So we've seen a few market abnormalities there in terms of what's happening. But in terms of stock, there's obviously house builders are trying to overcome some of the material shortages and also get back some of that lost time that we saw from the lockdowns in 2020.
Something else I wanted to touch on quickly today was the statement, a ministerial statement from the Ministry of Housing, Communities and Local Government on cladding the other week. Been inundated with emails and questions from lenders seeking the current position from a valuation perspective, and has anything changed following that statement, to which what we've been told internally is that there is no imminent change from the mainstream lenders that we're working with, and there hasn't been an update of such change from the RICS. So a bit of a conflicting statement there.
Yeah, it's the cladding situation here in the UK, and obviously the EWS1 forms, which we have to request as well now with a covering letter from the assessor, as regulations and protocols for that remain very stringent. There was some easing on the requirements for EW1S forms for those buildings less than 18 metres in height. However, there was certain caveats to that regarding the sort of facing materials on the cladding, if it's any MCM, metal containing materials, and other metallic materials on there, high pressure laminate included. If there's any of those on any part of the building, as well as any vertically stacked balconies, an EWS1 form is still required. And like you say, Rob, lenders have not communicated to us in any instance the easing or the changing on their lending policy, and any easing on the current guidance, which would require the EWS1 forms.
Great. Thanks to everyone that's been sending your questions and your emails in relation to all the subject matters that are happening week in, week out in the property market. We are here to give you the best guidance, advice, information, data into what's happening on the ground, and where we can provide that to you, we will continuously do so. What else this week?
Well, if we move back to the high street, we know that Sweaty Betty, the upmarket British activewear brand, has been sold to a US footwear firm in a deal worth in the region of £295 million. After a year-long sort of sales process there, it was initially anticipated that the activewear brand would achieve in the region of 400 million, but it closes at around 295. We've seen in the past 18 months, as a result of COVID-19, possibly more people buying, wearing fashion activewear, could possibly have helped to strengthen the brand's position there. But anyway, we're expected for some expansion possibly in some of their stores, not only in the UK but across Europe and obviously the US following this takeover. But I think some positive news ultimately for the high street there, possibly moving more to the online sales as well.
Great. And final news for this week?
Final news, we'll come to sort of the professional services, property and surveying. We know that CBRE has paid around £960 million for a majority stake in Turner and Townsend, which are largely involved with quantity surveying, project monitoring, surveying. The move is expected to be completed in the final quarter of 2021, which will see the American-based firm take a 60% stake in the business, with the remaining 40% held by TNT. With CBRE stating that it will keep the TNT, Turner and Townsend branding for the time being at least, but a further expansion of CBRE here in the UK. And just lastly, Connels Group, in terms of their profits, they've announced this week that their profits have risen to 80.2 million over the last 6 months, following their takeover of Countrywide, which I think they've taken full advantage of a positive housing market in the last 6 months. Connels acquired the estate agency group in March earlier this year, and has stated that it has helped them boost their profits. If we take the same period for 2020, those 6 months, their profit was 17.2 million. So a massive jump in the last 12 months, albeit the previous period was partially affected by the pandemic. But some very strong performance figures there from the Connels Group.
Great. Thank you for everything this week, James. Thanks for all the intel, data and news. Thank you everyone for watching, listening, whether on YouTube, whether through the podcast. And if anyone doesn't have access or isn't receiving the data via our newsletter every week, please reach out on whatever platform. We will ensure that you're getting all of the latest information every week as it comes hot off the press. And that's it for this week. So thank you everyone. Another edition, #AskRobCo. Keep well, be safe, enjoy the summer. It looks like many of you are taking a longer summer than normal, so enjoy it. Hopefully the good weather is about to return, I very much hope. And we will see you all next week. Thanks, James. Thanks, everyone. Take care.
Thanks very much, everyone.